Hey, what's going on, everyone? We're back again with another video to help you guys get ready to purchase a home.
Yeah, it's gonna be a great one. This one is very important. This one we got qualifying for a home this week. So Edgar's gonna be dialing you in and really giving you specific details on what it's gonna take to get that pre-approval.
Yeah, so most of this information is just generic, general for everyone, so it's not real specific. So just to get started, ideally we want a 620 credit score. There's some programs that allow you to go down to 550 or 580. But I always like to tell my clients, if you can get to 620, your interest rate's gonna be a lot better versus one at like 598 or 601. I can help you look at your credit report and find out what you have to do to boost up your credit to get at that 620 mark. Another key thing, you have to have at least a 2-year work history. There's a lot of misconception that you have to be with the same employer for 2 years, but that's not even the case. You can switch jobs around. Like for example, you have some clients that,
definitely that they've started somewhere. It's kind of like almost they've got a promotion. They work for a different company now, but it's the same field of work. So don't think that that's going to push you back another 2 years. We're just going to kind of run those along seamlessly. So
if you're a student and you get a degree, and let's just say you became a nurse.
Oh yeah. That's good.
Yeah, you can use those college transcripts like, hey, this is my 2-year work history, because then now you got a job in the career that you're studying in, or in the field that you're studying in. So that's another thing that people don't know about.
Yeah, and highlighting too that credit score. No, you're fine. You can leave it. Just highlighting the credit score too. Going back, you can have a lower credit score because you probably see stuff. I'm sure you see stuff on the internet. You could get qualified for as low as a 520 or whatever the case. Yeah, you can. It's the same thing like going to get it approved for a car. You're going to have a 30% interest rate. That's not what we want. So getting that pre-approval with Edgar is really going to dial in like, okay, if this is what your credit looks like right now, here's what your payment's going to be. But if we bump you up X amount more points, here's how much lower your payment's going to be each month. So that's why it's really important to get the credit score higher.
And this is why we're huge advocates in starting early, because let's just say you want to buy a house next year and you want to work on your credit. I can give you some tips and tools on what you can do to boost your credit. By the time you are ready, you might be in a 740 range.
Yeah, definitely.
The next thing is income requirements. So you got your credit, you got the job history that's required. Now, how do we look at your income? We look at your gross income to qualify for a home loan. Typically, you can go up to 45% of your monthly gross income, and that'll determine what you can qualify for. Sometimes you can go up to 50, but just to be safe, we always like to look at the 45% range. The income has to be predictable and consistent. So for example, if you're a full-time employee getting 40 hours a week, that's predictable. If you work overtime consistently week over week, that's predictable. Now, if maybe you have a part-time job and your hours fluctuate based on several factors, that's unpredictable. So we have to look at the 24-month trend to determine what you can qualify for. Some of the jobs that can vary hours are like nurses, police officers.
For sure, yeah. Arborists, like if you cut trees, sometimes that job depends on like the weather. Linemen, journeymen, if you're a specific contractor of the state, right? If you do government work or union jobs, sometimes those are only half of the year or what have you, right? But all those things, as long as they're easily trackable or there's something that we can go back and talk to the employer about, it's very easy to get a hold of. Again, predictable and consistent. That's what we're looking for. But if not, it throws in a couple loopholes, maybe a little bit more variables. Not to say it can't be done, but what we're looking for is definitely predictable and consistent.
Solid. So then let's just say we got your income dialed in. Then we got to look at your down payment. Where is the money coming for your down payment and closing costs? So pretty plain, straight up, checkings and savings, the money that you put in from your work. Maybe you are self-employed and you have a business checking account that all the income goes in there, whatever, you get the idea. It's your personal checkings and savings.
Yeah, for sure. Just a bank account, a mattress doesn't work. We joke about it sometimes, and like just realtors as a whole, like a picture of money under a mattress isn't a proof of funds. So we need to see bank statements, need to see the money in your account, right? Not someone else's.
Yeah, we usually ask for 2 months of your bank statements because we also keep an eye out for large cash deposits. So
this one right here. So if, depending on what type of work you do, we don't judge. Everyone has to make money. We understand. But if you are doing large cash deposits, try and keep them under $5,000. This isn't financial advice, but to my understanding, if you are depositing cash, cash and it's under a specific amount, it doesn't raise up an IRS red flag, so your bank account doesn't flag you and say, hey, maybe you guys should audit this person, they're depositing so much money at a time. That's not something you want going on when you're trying to buy a house. You really don't want the IRS probing you. So just things to be mindful of. Don't put huge amounts of cash all at once, right? If it's gambling winnings, totally okay, right? Because there's going to be a receipt for that. Maybe you got paid out, all that stuff. But again, just they're red flags. So try and keep it minimally.
Yeah, that's a good point. And then if you sell a car, you can get a bill of sale or a motorcycle.
100%.
Show proof. We also have to show, hey, this car was worth this much by providing a Kelly Blue Book valuation report.
Yeah.
Then you can use that money. Yeah. Some people don't even like keeping their money in the bank. So after you get paid, you take the money out. So if that's the case, if that's you, put the money in your account, and then you have to wait 60 days after that has happened, or sometimes 30 days, and then you'll be in the clear, and you wouldn't have to worry about sourcing those large deposits.
Yeah, and this is a funny one too, not to go a little off topic. Gold. I know some of my older clients have gold. So if you have gold and you're trying to go and trade in the gold for cash value, so there's going to be a receipt for that sale too. So those types of things can be transacted as well. It's just having some sort of paper trail so it doesn't look like you just anonymously came upon $30,000 or $50,000 that the government doesn't know about. So
I have clients that are hairstylists, they do nails, and they get paid Venmo, they get paid Cash App.
For sure.
All those things, because you have a legitimate business and you have taxes filed, we're going to be fine.
Yeah.
Another way you can get money for your down payment is tapping into your 401k, talk to your 401k company. Typically you can borrow up to 50% so you don't get hit with all the tax withholdings, because if you just cash it out, you're going to get smacked with the 35% or whatever it is withholding. You basically lose those gains.
Yeah.
But if you borrow against it, you pay yourself back.
Yeah, that's a good point too. Yeah, definitely talk with whoever is working with you for your 401k, or if it's your employer, see what type of limits or restrictions there are before you pull any money out, and make sure you let them know that specifically that you're trying to pull it out to purchase a home, because sometimes that can have a huge differentiating factor on what ends up happening with that money and how it's taxed and how you pay it back. So Edgar's right about that for sure.
So this next one is pretty cool. The gifts from family. Yeah. Some people are fortunate to have family members that can gift them funds. There's really no limitations on how much you can get gifted to you. So if your grandma, your dad, your cousin, your uncle, and this is where it's a kind of a gray area, but for the most part, almost anybody can gift you funds. You can even get a gift from funds from close friends.
Yeah, see, I actually, he just told me about that right before we started, because I thought there was still one group. It always used to be something one group, like a cousin or an aunt or an uncle couldn't give you funds. But yeah, he told me, and I thought that was pretty cool, that a close friend could give you funds if you wanted to get into a house. So that's pretty neat. So there's no necessarily, I guess, excuse on where to get those funds from. If you really want to get into it, there's all these different avenues that we can go down. Just got to choose the best one for you. That's for sure.
Yeah. So FHA requires a minimum of 3.5%. Conventional for first-time home buyers is 3%. If you're buying another home within 3 years, it's 5% for conventional. VA 0%, and there's also a program for the rural areas in Fresno or the greater counties. 0% USDA loan.
Yeah.
Each program has its specifications, whatever. But then that's where closing costs come into play.
Yeah, I was gonna say, if you want to hop over to the other slide too, just kind of tying in with the FHA. So most people, when they come to get pre-approved, at least in my personal experience, it's either conventional or FHA. Of course, we get VA, we love our veterans, but USDA and different ones like that, they're more subjective to specific locations. But for the FHA and conventional, anywhere, let's just say with FHA, 3.5% down on a $300,000 house, you're probably looking at somewhere around about $9,000 to $12,000, $9,000 to $11,000 for your down payment. And then your closing costs, what would you say, Edgar, is anywhere from 2 to 3% most of the time of the purchase price too?
Yeah, and closing costs consist of your title and escrow fees, which is the middle company between the buyer and seller, prepaying insurance for the property taxes, and then other miscellaneous fees like inspections and things like that.
Yeah,
can range, like you said, 2.5%, 2%. But the beauty of that is if you got a great agent to help you negotiate with the sellers, you can get that covered.
Yeah, so you can get your closing costs sometimes covered from the seller. It's just a form of a credit back just from the purchase price, depending on what we offer. So that way you're only having to come in with that 3.5% down payment. So the reason why I'm bringing that up is if a 3.5% down payment of a $300,000 house is somewhere around 10 grand, and we can get your closing costs covered by the seller, and let's say you get gift funds from your best friend that loves you so much, or your mom that loves you so much and wants to see you get into a home, you're virtually having to come in with almost no money out of your pocket, maybe just inspections money and your appraisal fee up front. So that can bring what would be maybe a $20,000 to $22,000 ticket cash out of your pocket down to about $1,500 to $2,000, depending on what your situation is. And everyone's is different, but these are just the possibilities. So that's why I like to bring it up.
And a lot of people like to ask me about down payment assistance programs. I'll share that with you guys on a one-on-one case basis because everybody's scenario is different. Sometimes it doesn't make sense to do down payment assistance. We'll get more into that in a different video. But just for a quick summary, we also have a slide here kind of going over what you have to actually earn and what you can afford based off your earnings. So
nice.
Yeah, so if you made, let's just say $5,000 per month and you don't really have much debt, like you don't have a bunch of credit cards and 3 or 4 car loans under your name, then you can qualify for a purchase price of like $295,000, or then your payment would be $2,256. This is based off an FHA. That payment includes property taxes, homeowners insurance, mortgage insurance. So everything's included in that payment. And this is also based off of 5.9 interest rate, with the APR would be around 6.3. But that's essentially what you would be able to qualify for $5,000. With that being said, close to $300K. What do you see right now in the market for $300,000 in Fresno County?
Just depending on what you're looking for, right? So $300,000. I just say for everybody, where we like to start is go over what's important to you, right? Is it 3 bedrooms, 5 bedrooms, whatever that looks like? Let's start with what your perfect house looks like, and let's see what we can find in that price range. So if everything that you're saying you want, we can identify in a $300,000 price range, fantastic. If not, okay, let's go back to the drawing board and see, okay, maybe we need to remove a bedroom or a little bit smaller of a lot, or not a 3-car garage, different things like that. We just try to see how we can still find something that makes sense for us in that price range if we're having a tough time finding it. But I would say around the $300,000 price range, it's definitely competitive because there's not much that comes up. If it does come up and it looks really good, it kind of sells fast, honestly. Getting around that 350, still the same. If it comes up and it looks great, it moves very, very fast. I would say right around the 400,000 is where you start to see a little bit more of an ease up as far as the competition goes, and you start to see houses that are a little bit more turnkey as well too. So all these though, fantastic price ranges. What is this? 5,000 times 12, what is that? 60,000 a month or a year? Was it 72,000? Yep. And was that $84,000 a year? So just to give you an idea, $84,000 a year. This is a $400,000 house. So if you and your husband or your husband and wife, whatever, you guys make around $40,000 each, you're already probably looking around a $400,000 price range, So definitely these are great things to keep in mind. Chat with Edgar about getting pre-approved and seeing what it takes for your specific situation, because everyone's different in order to qualify for a home.
Yeah, and then the other thing too, let's just say you can afford it. Maybe you don't have the 2-year work history, or maybe your spouse just started a job, or maybe they just started their business and you can't afford it, but technically you don't qualify on paper. You can always add a cosigner and take them off 6 months, 12 months later. And you can add up to 4 co-signers. I've had files where a whole family goes in and purchases a home together. And
just sorry to cut you off. Can you have, I think it's 10 borrowers on a loan, or depending on what type of loan? I've heard some crazy stuff before. So
they cap it out at 4 now.
Okay.
So it's at that point, like, you can have up to 4 borrowers, and then also too, just depending if each borrower is married. So now this is where it gets a little tricky.
Yeah.
We got to, because FHA, for example, government-backed loans, FHA, VA, and USDA. If you're married in the state of California, we also have to disclose your spouse's debt. So if you're, let's just say, a husband going in on the loan by yourself, we have to include your spouse's liabilities to make sure that you can qualify for for the home itself, but then you also have to qualify with your spouse's debt. So that's where it may make sense to go conventional instead, because with conventionals, we don't have to disclose your spouse's debt. So that's where we come in as loan officers. We have to figure out what's the best situation to make sure that you get into the home without any like setbacks.
That's a fantastic point.
Yeah.
That's great. That's great stuff.
So I mean, that kind of summarizes what we're looking to talk about as far as qualifying, what you need, credit score, your income, job history, talking about sourcing the down payment funds. And I just kind of want to touch base on some of the things that
just even touching on this right here. I mean, like how you said with you could get pre-approved with a co-signer and then refinance them off later. Don't be so prideful. And this isn't to like attack anybody specific if this is how you feel, but if your mom or someone in your family is kind enough or able, in a position to sign off on helping you buy a house, and that's the only thing stopping you from getting into the home, like you can afford the payment every month, but you just want to do it on your own without your parents, that I'm not saying that that's a wrong thing, but don't let your pride get in the way or your ego get in the way of putting yourself in a fantastic situation to where in 6 months down the line, if interest rates drop, or just if you really are so fed up with it that you can't handle it, you can refinance them off and take them off of the loan, take them off of title, whatever, and it just have you. So I just wanted to kind of revert back to that really quick. To if you're in that position, don't sell yourself short. I would definitely go for it.
Yeah, and then going back to this area where, how much money do I need? Ideally, aim for the down payment, 3.5% of that purchase price. Now, I wanted to ask Dylan, like, what do you see right now with what's the best strategy to get closing costs covered? Is it a house that's been on the market for quite some time?
Yeah. No, that's a great question. So definitely. What I say is once you have your down payment, if you want to buy a $400,000 house and you have 3.5% of that saved up, we can start shopping. It's not to say that 100% on every house that we love, we're going to get our closing costs covered. What I think a big part of that is depending on how much traction that house is already getting, how good the rest of our offer looks, and then also too how long it's been sitting, right? So that's a big part of it. If it's brand new home on the market, turnkey, looks beautiful, odds are there's gonna be some other offers too. It's not to say they're not asking for closing costs, or maybe they need to sell a house or have some weird situation. One thing that we could do right off the bat is just offset that price with our offer. So if we're needing a $12,000 in cash to close, and just for the closing costs, right? And we're offering on a $400,000 house, maybe we offer $410 or $412 to offset the difference. And for you, payment wise, that might change your payment $80 to $100 a month, right? Worst case scenario, but you get into the home. So that's one thing you could do, is offsetting the purchase price with the difference in the closing costs that you need. Another thing is, if the home's been sitting for a while, it's not getting a lot of offers. Usually you can get a little bit more wiggle room on the negotiating, so we don't have to necessarily offset the price so much. We can come in and ask for that closing cost from the seller, see if it's something they're willing to work with, and then go from there. Now,
switching gears real quick, talking about a seller. Does it make more sense for a seller to do a $10,000 price cut or offer $10,000 for closing incentives?
Ooh, that's a good one. So I think it depends on the buyer specifically, right? If a buyer, because everyone likes to do different things with their money, right? So if a buyer has the cash accessible and they're willing to use that money towards the house, and they don't want to take a closing cost credit, if they don't want to use that money for buying furniture or sprucing up the house, they want to just go in, I would say take the lower purchase price. And again, it's only gonna say maybe $80 to $100 depending on what price range you're in or how big of a difference the closing cost is. But it's personal preference. I would like to take, if it was me, I would take the closing cost credit and I would keep the cash in my pocket, and then I would use that money so that way I could buy things like furniture, spruce up my house, and do that. Because I personally, I like to have the cash more accessible. But again, everyone's a little bit different, whatever you prefer, but those are definitely good options for you.
All right. Well, that pretty much summarizes what we were planning on talking about today. If you have any questions regarding the buying process, talk to Dylan. Reach out to him. He's done this hundreds of times with clients and successfully has negotiated closing costs for his clients. And then if you want to get pre-approved or figure out where you're at, that's where you reach out to me. We can help you out.
Yeah, no, I appreciate you guys tuning in. Definitely don't feel like if you don't have $30,000 in the bank that you can't buy a home. Time after time, we've gotten people super unique scenarios. And just to kind of throw in a little lob for new construction, a lot of times they have some things that we can do and finagle there too. So if their home is trying to get gone, we've figured out scenarios where if they want to sell it, we can work out something between us that'll make it work for you too. So everything kind of has a full circle where depending on what you're trying to do, we can work it out. So again, don't think that you need $30,000. We can get you in for as little as $5,000, sometimes $2,000. So thank you guys again. You take care.
Yeah. See you.